Good day, we are the Group 3 and our report is the Chapter 11 Financial Stability, Monitoring and Identifying Risk. I am Queenie Lasra and my topic is to discuss the monitoring and identifying risk in the macroeconomy. To monitor and identify financial stability risk in the macroeconomy, the central bank might want to look at the balance sheet of a different groups of economic agents, household, and firms, as well as the macroeconomy itself. Over-indebtedness by any of the key agent of the real economy, household, firms, and the government, as well as the over-indebtedness of the economy as a whole to external creditors could lead to financial imbalances that weaken the financial sector and ultimately lead to financial instability. Although over-indebtedness of agents might be difficult to identify, the central bank might also consider adopting the gap measurement approach advocated by Claudio Borio and Philip Lowy in two separate papers that published in 2002, whereby the actual level of credit to GDP is compared to its historical trend as an indicator of agents' degree of indebtedness. In addition to monitoring the indebtedness of economic agents, the central bank might also want to monitor and identify the risk from the asset side of the economy. Next, the image shows figure 11.1, the factors in the macroeconomy that may affect financial stability not only in the macroeconomic itself but also in financial institutions and financial markets through interrelated areas. Fast rising assets prices, such as those in stocks and the real estate markets, could indicate the possibility of widespread speculation in asset prices and possible asset price bubbles. Speculation in asset prices often induce more and more players to make on heavy debt loads in order to bid for asset. Next is the household sector. At the most basic level, the central bank might want to look at the rate of growth of overall household debt of the composition of a debt, for example, the mortgage, credit cards, and the auto loans. Data on household debt might come from various sources, including loans granted to individual and household financial institutions and comprehensive household survey. So, the experience from the global financial crisis has shown that the fast rising mortgage debt, even when accompanied by fast rising household wealth itself due to fast rising stock and housing prices, can lead to financial instability when the economy slows down or when housing prices start to drop. The next one is the corporate sector. Similar to the household sector, at the most basic level of the central bank needs to look at the growth rate of corporate sector debt to monitor and identify risk in the corporate sector. Pertinent data would include loans to the corporate sector by financial institutions as well as bond issuance by the corporate sector itself. The dot-com bubble in the early years of 21st century suggests that fast-rising corporate debt, even in the midst of the economic boom and rosy economic prospect, should be closely monitored. During an economic boom, firms might decide to use borrowed funds to undertake large capital investment with rosy economic prospect. Large capital investment, however, often take time to pay off, and thus, once the economy is low, firms might find it difficult to repay their large debt loads. In addition to looking at the growth rate of corporate debt, the central bank might find it useful to examine the components of a corporate debt, for example, whether the loans are short terms or long terms, and whether they are denominated in local or foreign currency.
My name is Sheena L. Orlunida. I am the second reporter. My topic is the government sector. Means the central government, state government, PSU or regulatory authorities in India. For example, public sectors include the public goods and governmental services such as the military, law enforcement, infrastructure, public transit, public education, along with healthcare and those working for the government itself such as officials. Next, the external sector. The external sector is the portion of a country's economy that interacts with the economies of other countries. In the goods market, and external sector involves exports, imports. In the financial market, it involves capital flows. Why external sector is important? It also shows income, capital, and financial interaction between the economy and the rest of the world, as well as changes in the amount of economies, official reserves, the stock of gold, foreign exchange, and similar assets held by the country's monetary authority or central bank. And the last one, asset price bubbles. An asset bubble occurs when the price of an asset, such as stocks, bonds, and real estate or commodities, rises at a rapid pace without underlying fundamentals to justify the price spike. How should we respond to asset price bubbles? Instead, monetary policy should react asset price bubbles by looking to the effects of asset prices on employment and inflation, then adjusting policy as required to achieve maximum sustainable employment and price stability.
Good day everyone. I am Geraldine Oray and I will discuss about the assessing individual institution, financial market and prices and yield. First, I will discuss the assessing individual institution risk. Assessing individual institution risk is a traditional regulatory authorities have assessed individual institutions' safety and soundness by examining the institution's CAMEL. CAMEL stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. Regulatory authorities recognize that examination of financial institution must place greater emphasis on the institution risk, management practices, and internal controls. At the same time, it should be noted that the failure of a single or even couple of financial institutions may not necessarily cause serious threats to the stability of the system as a whole, provided the failed institutions are not large or systematically. Next is the financial market. Financial market indicators can provide useful information on the degree of risk accumulation as well as the degree of stress and disruptions in financial sector. Indicators of risk in financial markets can often be extracted from transaction data in the financial markets, whether they are movement and prices and yields of financial products or net positions of market players. Financial market exists for several reasons, but the most fundamental function is to allow for the efficient allocation of capital and assets in financial economy by allowing a free market for a flow of capital, financial obligations, and money. The financial market make global economy run more smoothly while also allowing investors to participate in capital gains over time. Without financial market, capital could not be allocated efficiently, and economic activities such as commerce and trade, investment, and growth opportunities would be greatly diminished. Next is the prices and yield. Despite the presence of information asymmetry in financial markets, prices and yields of financial products and financial derivatives should reasonably reflect publicly available information on those products. Unusual movement in prices and yields of financial products would thus signal to the central bank threats to financial stability that might arise from financial markets. Bond price and bond yield are inversely related. As the price of bond goes up, the yield decreases. As the price of bond goes down, the yield increases. This is because the coupon rate of the bond remains fixed, so the price in secondary markets often fluctuate to align with prevailing market rates. Also, bond yields are significantly affected by monetary policy, specifically the course of interest rates. Bond yields is based on the bond coupon payment divided by its market price. As bond prices increase, bond yield fall. Falling interest rates makes bond prices rise and bond yields fall. That's it. That's all. Thank you.
Good day, ma'am. Adahar Shinami is reporting risk accumulation. So, as discussed earlier in the chapter, fast rising price of equity when taken together with credit growth could reflect the risk accumulation that comes with speculative activities and asset price bubbles. In general, fast increases in price of financial products, whether stock, bonds, or securities backed by subprime mortgages, can draw in more and more market player participation during the price run-up. In bidding for the higher returns, marketplace often found their purchases in financial products using leverage or borrowed money. So, as we can see at the figure 11.3 of financial stability issues in financial markets, microeconomic is the above, then financial institution is the left side, and the financial markets is in the right side. Chains of default might come from market description, liquidity freezes, or large and extreme price swings. So, as we can see as the arrow, the area of concern of financial stability is the center. Then, area of concern for financial stability, the arrow is going to center of the three issues. So that means as long as a price of products keep rising, players are attempting to pile not even more leverage to buy more products, possibly by using the products themselves as collateral for more borrowing. In speculative assets, price bubbles price of financial products can rise far beyond level justified by their economic fundamentals. Thus, greater degree of leverage would lead to even more losses. Although it is difficult to determine ex ante if prices of financial products have risen beyond their economic fundamentals or not, it is critical that the central bank examines unusually fast run-ups in the prices of financial products very closely, even if the central bank itself does not trade in those products. Stress and description. While fast run-ups in prices of financial products could reflect a rising degree of risk accumulation in system, rising volatility in the financial product prices could reflect a rising degree of stress and description of financial market. As financial market prices should reflect the publicly available information relating to the market, rising price volatility or unpredictability suggests that market players are not very certain about the quality of information that they have and every sensitive to new information. There are two key to measure of price volatility. First is historical volatility, which is calculated from historical price data, and option implied volatility, which is calculated from historical price data. Second is option implied volatility, which is calculated from option price of their underlying financial products when options on those products are available. Spreads in financial market terms, a spread often refers to the difference in yields of two types of financial products. Example, a spread between corporate and government bond yields of the maturity, which means the difference in the yields of these two are bonds.
Good day, ma'am. I am Asalat Sharel, and I will be the one to continue our report, and my assigned topic is Case Study LIBOR OIS, or Overnight Index Swap, spread as an indicator of stress and disruption. So during the 2007 to 2010 crisis, LIBOR OIS spread became another important financial variable to monitor as it reflected credit risk of the banking system as well as liquidity risk in financial markets. So LIBOR rate is the rate of interest at which banks offer to lend money to one another in the wholesale money markets in London. It is a standard financial index used in US capital markets and can be found in the Wall Street Journal. So in general, its changes have been smaller than changes the prime rate. The London Interbank Offered Rate, or LIBOR, is a benchmark interest rate at which major global banks lend to one another in the international interbank markets for short-term loans. Overnight Index Swap OIS, or Overnight Index Swap, is a fixed or float interest rate swap whereby a counterparty agrees to receive a fixed rate of interest called OIS rate on a national amount of money over a maturity, example 3 months, in exchange for a compound interest payment to be determined by a reference floating rate on the national amount at the maturity. The reference floating rate is often tied to an overnight interest rate such as central bank's policy rate, example the effective federal funds rate in the United States. As such, the OIS rate reflects the market expectations of the average of the reference overnight interest rate over the maturity of the swap contract. So overnight index swap, or OIS, is an interest rate swap agreement where a fixed rate swap against a predetermined published index of a daily overnight reference rate, for example, SONIA or ERINIA. An index swap refers to hedging contract in which a party exchanges a predetermined cash flow with a counterparty on a specific date, applies an overnight rate index such as the Federal Funds or London Interbank Offered Rate rates. Index swaps are specialized groups of conventional fixed rate swaps with terms that can be set from 3 months to more than a year. The next is monitoring LIBOR OIS to gauge risk. LIBOR OIS spread is the difference between the LIBOR rate and the OIS rate. LIBOR rate typically includes credit risk since a LIBOR transaction is not secured by collateral and thus the lending bank is exposed to a default by the borrowing banks. OIS, on the other hand, involves only a minimal credit risk since the transaction does not involve any initial cash flow. The payments between the two counterparties is an OIS transaction would occur only when the contract reaches maturity. So a decade ago, most traders didn't pay much attention to the difference between two important interest rates, the London Interbank Offered Rates, or LIBOR, and the Overnight Index Swap, or OIS rate. That's because until 2008, the gap or spread between the two was minimal, but when LIBOR briefly skyrocketed in relation to OIS during the financial crisis beginning in 2007, the financial sector took note. So today, the LIBOR OIS spread is considered a key measure of credit risk with and the banking sector. Net open positions. A net open position in a financial product refers to a situation in which players' total assets and liabilities in that particular product are unequal. If a player has an excess of assets over liabilities in that particular product, then the player is said to have a net long position that product. If a player has an excess of liabilities over assets, then the player is said to have a net short position. So the net open position should be calculated as the sum of balance sheet holdings of equities and notional positions and equity derivatives. The net position is positive if it is a long position and negative if it is a short position. The position in the market must be calculated on a market value basis.
Hey, ma'am. Good day, classmate. I am assigning the rest accumulation. Rest accumulation in a case where the data are available. In the central bank might find it a useful to monitor the aggregate net open position for a key financial product, such as foreign currencies, a dramatical rest in the net open position, whether long or short means that the rest accumulation in the system is resting, since players are exposing themselves to adverse moves in the foreign exchange rates. So, rest accumulation, it is the potential loss exposure of one event spreading the multiple lines of business in an insurer's portfolio, uh, or it a clash. So next is stress and disruption. A net open position in a financial product when taken together with a movement in the price or yield of the product could also reflect a degree of stress and disruption in a particular market segment. Stress and disruption. For me, it is losing your job or being retouched, or it is a long-term unemployment, being unavailable to get full-time work, or inability to pay your bills, or not being able to deal with the increasing cost of living. So uh, the stress disruption, it is an impact to the employee who worries about psychological distress among the adult or less moderate